Hey everyone, it's Rita. Welcome to the First Time Homebuyer series. Buying your first home is exciting, but it can also feel overwhelming, especially if you don't know where to start. Are you ready to buy your first home but feeling lost in the process? Don't worry, you're in the right place. In this series, I'm going to break down every single step of buying your first home from start to finish. We'll cover everything from mortgages and credit scores to finding the perfect home and closing the deal. My goal is to make this process as simple, stress-free, and easy to understand as possible. Before we dive in, don't forget to like, comment, and subscribe for more helpful videos like this. Your support helps me create more content to guide you on your homeownership journey. Alright, let's jump right into step 1. Getting pre-approved for a mortgage. This is hands down the most important thing you need to do before you even start looking at houses. Trust me, getting pre-approved will save you a ton of time, energy, and potential heartache down the road. So, what exactly does it mean to get pre-approved? It means going to a lender like a bank or a mortgage company and having them review your financial situation. They're going to look at your income, your debts, your credit score, all that fun stuff, to determine how much money they'd be willing to lend you for a mortgage. Think of it like this. You wouldn't go car shopping without knowing your budget, right? Well, the same logic applies to buying a house. Getting pre-approved gives you a clear picture of what you can afford so you don't waste time looking at homes that are outside of your price range. But here's the thing, and this is a big one. Getting pre-approved doesn't just benefit you. It also makes you a much stronger buyer in the eyes of sellers. In a competitive market, sellers are more likely to take an offer seriously from someone who's already pre-approved because it shows that you're not just window shopping. You're a serious and qualified buyer. It's like having a golden ticket that says, "Hey, I'm good for it." Now, I know some people might be thinking, but Rita, what if I get pre-approved and then I don't find a house I like? That's totally fine. Getting pre-approved doesn't obligate you to take out a loan. It just gives you a clear picture of your financial standing and puts you in a much stronger position when you're ready to make an offer. So, how do you actually get pre-approved? It's easier than you might think. You can start by contacting your bank or credit union, or you can shop around and compare rates from different mortgage lenders. They'll walk you through the process, which usually involves providing some financial documents like pay stubs, tax returns, and bank statements. Trust me, guys, getting pre-approved is one of the smartest things you can do when you're starting your home buying journey. It sets you up for success, gives you peace of mind, and helps you avoid unnecessary stress. So, before you start scrolling through endless listings, take the time to get pre-approved. You'll thank me later. Okay, so we just talked about getting pre-approved for a mortgage. And you know what plays a huge role in that process? You guessed it, your credit score. Your credit score is like your financial GPA. It tells lenders how responsible you are with money and how likely you are to repay your debts on time. Now, I know talking about credit scores might not be the most exciting thing in the world, but trust me, it's crucial to understand how they work, especially when it comes to buying a home. The higher your credit score, the better interest rates you'll qualify for, which can save you tens of thousands of dollars over the life of your loan. Think about it. Would you rather pay a lower interest rate on your mortgage and have more money to spend on travel, investments, or that fancy coffee maker you've been eyeing? Or would you rather pay a higher interest rate and essentially throw away money that you could be using elsewhere? Here's the deal. Lenders use your credit score to assess the risk of lending you money. A high credit score tells them that you're a low-risk borrower, which means they're more likely to offer you favorable loan terms, including lower interest rates. On the other hand, a lower credit score can signal to lenders that you might be a higher-risk borrower, which could result in higher interest rates, or even getting denied for a loan altogether. I know it might sound crazy, but even a small difference in your interest rate can have a significant impact on your monthly mortgage payments and the total amount of interest you pay over time. For example, let's say you're looking to buy a $400,000 home with a 30-year mortgage. With a credit score of 760 or higher, you might qualify for an interest rate of, say, 6%. But if your credit score is lower, like around 620, you could end up with an interest rate of 7% or higher. That 1 percentage point difference might not seem like much, But over the life of your loan, it could cost you an extra $70,000 or more in interest payments. That's a lot of money that could be going towards your other financial goals. So, how do you check your credit score? It's actually pretty easy. You can request a free credit report from each of the 3 major credit bureaus: Equifax, Experian, and TransUnion. Once a year at annualcreditreport.com. This report will give you a detailed breakdown of your credit history, including any outstanding debts, late payments, and other factors that might be affecting your score. Once you have your credit report, take some time to review it carefully and make sure everything is accurate. If you find any errors, like incorrect information or accounts that aren't yours, dispute them with the credit bureau immediately. Remember, your credit score is a powerful tool in the home buying process. By understanding how it works and taking steps to improve or maintain a good score, you'll be in a much stronger position to qualify for the best loan terms and ultimately achieve your dream of homeownership. Chapter 3. Okay, so you're ready to buy a house and you understand the importance of a good credit score? Awesome. Now let's talk about some different loan options. When it comes to mortgages, there are a few main types that you'll come across, and each one has its own set of requirements, including minimum credit score requirements. Let's break it down. First up, we have VA loans. These loans are specifically for eligible veterans, active military personnel, and surviving spouses. VA loans are amazing because they often come with 0 down payment options, meaning you might not have to put any money down up front. Imagine that, buying a home without a huge down payment? To qualify for a VA loan, you'll generally need a credit score of 620 or higher, although some lenders may have more lenient requirements. Next, we have USDA loans. These are designed to help low to moderate income borrowers buy homes in eligible rural areas. Similar to VA loans, USDA loans also offer 0 down payment options, making homeownership more accessible for those who might not have a lot of cash saved up for a down payment. For USDA loans, you'll typically need a credit score of 620 or higher. Now, let's talk about FHA loans. These are insured by the Federal Housing Administration and are a popular choice for first-time homebuyers because they often have more flexible credit score requirements. You might be able to qualify for an FHA loan with a credit score as low as 580. But keep in mind that you'll usually need a down payment of at least 3.5% of the purchase price. If your credit score falls between 500 and 579, you may still be eligible for an FHA loan, but you'll likely need a 10% down payment. Finally, we have conventional loans, which are not backed by any government agency. Conventional loans typically have stricter credit score requirements, generally starting around 620 to 640 or higher, depending on the lender. With conventional loans, you'll usually need a down payment of at least 5% of the purchase price. But putting down a larger down payment, like 20%, can often help you secure a lower interest rate and avoid paying private mortgage insurance, or PMI. PMI is an extra monthly fee that's added to your mortgage payment if you make a down payment of less than 20%, so it's something you'll want to avoid if possible. Remember, these are just general guidelines, and specific loan requirements can vary depending on the lender and your individual financial situation. It's always best to shop around and compare offers from different lenders to find the best loan program and interest rate for your needs. And don't be afraid to ask questions. Lenders are there to help you understand your options and guide you through the process. So there you have it, the first crucial step in your home buying journey. Getting pre-approved gives you a clear picture of what you can afford, shows sellers you mean business, and helps you move forward with confidence. I know it might seem like a lot to take in, but remember, you don't have to navigate this process alone. I'm here to guide you every step of the way. Getting pre-approved is the first step to homeownership, and I'm here to help you every step of the way. Stay tuned for Step 2 in our first-time homebuyer series. Drop a comment below if you have any questions and let me know. Are you planning to buy a home this year? Let's get started.